The top business stories live from the Sky News City studio. A surprise boost for the US economy with stronger than expected growth during the final 3 months of 2023. Profits at London's biggest estate agency Foxtons beat expectations. We'll hear from its chief executive. And UK car production passes 1 million in more than a year for the first time since the pandemic. Good afternoon, this is Business Live with me, Ian King. We begin today with economic news from the United States and Europe. The US economy grew by more strongly than expected during the final 3 months of last year. It emerged this afternoon. US GDP expanded by 3.3% during the quarter on a year-on-year basis, according to the US Bureau of Economic Analysis. That represented a slowdown on the 4.9% growth rate recorded for the July to September quarter, but was still significantly ahead of the 2% that Wall Street had been expecting. Meanwhile, the European Central Bank has kept its key interest rates unchanged at 4% as focus turns to the timing of a possible interest rate cut. Well, financial markets are expecting a possible reduction in the Eurozone as early as April this year. But the ECB President Christine Lagarde said it was premature to be talking about cuts at all at this stage.
Our future decisions will ensure that our policy rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission.
Now, the last 18 months have been tough for estate agents as the sharp rise in interest rates has depressed activity in housing markets. But Foxtons, London's biggest estate agency, said today its 2023 sales and profits would be up on the previous year and ahead of city expectations. That was mainly due to soaring demand and a shortage of supply in London's rental market, which sent the company's letting sales up 16% to north of £100 million for the first time in the company's history. I've been speaking to Guy Gittins, the chief executive of Foxtons.
From our data, we saw that the volumes last year were down actually 22% across the whole of London, so the number of transactions down. There was also a slight decline in the average sales price last year, which we've seen rebounding a little bit towards the end of last year. And of course, this was all caused by the shock interest rate increases and what the knock-on effect meant for mortgage availability. And as the year rolled on, as we got towards the end of quarter three, going into quarter four, that momentum started to come back into the sales side of the market. And we saw a lot of new buyers coming in. We saw a lot of new sales starting to be agreed before the end of the year. And normally the market takes a little pause over Christmas, but actually that continued right the way across. And we started this year as probably the busiest year that we've seen for the last 2 or 3 years.
Did you see a lot of landlords getting into financial distress given the sharp trajectory of rate rises? And has that started to ease now?
Well, as London's largest estate agent for both sales and lettings, we deal with the largest group of landlords, and there were almost no distressed sellers coming to us as landlords during that period. But we did see that fewer new landlords were coming into the market, and that's been a trend over the last 3 or 4 years as policies have changed and as taxation has changed for landlords. We're definitely not seeing a mass exodus of landlords, more that the available stock differential between the demand metrics we're pushing those prices slightly higher.
You touched on mortgage rates just now. I mean, do you anticipate this price war rumbling on and continue to stimulate activity on the sales side?
We think that now there's good momentum. There's an opportunity for people to be able to get on with their property search, whether they're a seller or a buyer, if they're on the sales side. We think there's at least 3 months of very good activity in the marketplace. We've seen tens of thousands of new buyers returning to the marketplace in a really short space of time. And that momentum now, we know, will feed the market for at least 3 months ahead. Depending on what happens with swap rates and interest rates and mortgage rates over the coming months, that may temper that activity. But certainly, if I were a willing seller today, you've got a great few months ahead of you, I think, to be able to secure a sale.
Now, we're about 6 weeks away from the autumn statement. There's talk of a stamp duty cut in the air. What would you like to see from the Chancellor?
We'd love to see anything that helps First-time buyers get onto the ladder. It's so critical for London. It's so critical to be able to support that platform for people moving out of rented accommodation. We'd love to see anything also that makes it easier for new landlords to enter the market, because that creates a long-term stable economy. It creates an environment where where the price increases will be tempered, because of course there'll be more stock availability, and everybody has been impacted, whether you're a homeowner or not. Everybody's been impacted, and certainly businesses have been impacted over the last 18 months while those price increases for lettings have happened. So we'd love to see some change in stimulus for encouraging new landlords to come into the market. And also the upper side of the upper end of the market almost feels like there's a lot of landlocked older owners of properties who can't afford the stamp duty to do a downward move. So there's a lot of people caught in large houses, when actually if there was a more fairer stamp duty environment, you might see a lot more of that movement around, and that's what's caused quite a considerable reduction in overall transaction numbers if you look over the last 5 years compared to perhaps 15 years ago, where transaction numbers today in London are probably down 20% on that historic average.
Well, this is the point. I mean, in London, £1 million households, it's not unusual, and yet that's where stamp duty really kicks in. It's north of 10%. I mean, that doesn't really feel sustainable long term.
The market's had to put up with it for quite some time now, and ultimately it gets priced into the sale, but it does make movements much harder. So you've of course got to save that money as stamp duty. You can't add it onto the mortgage, and finding that extra cash on top of if you're increasing if you're moving up the ladder, or indeed if you're moving down the ladder, that's a big chunk of your equity gone that you're not going to get back. So it really does. That's really what we see has put the brakes on these larger volumes that we've traditionally seen in previous years.
You did a couple of acquisitions over the last 12 months, Atkinson, McLeod, Ludlow Thompson. Is acquisitions a big part of the strategy? Do you anticipate doing more this year?
100%. We have very much focused on changing the strategy over the last 18 months while I returned back to Foxtons. We've very much decoupled the performance of the business from the up and down sales cycle. Our revenue today is 70% lettings, and the remainder of that comes from sales and from our financial services business that we own. And by pivoting and focusing on acquisitions in the lettings environment, we've been able to make our incomes much more resilient, and that's a strategy that we will continue to spend. Last year we spent £15 million on those acquisitions. We've added over 3,000 new tenancies into our portfolio, and as we create the synergies from making those acquisitions, we buy fantastic clients, we buy brilliant people, and then we show them and supercharge what they've been doing before with our unique scalable platform that we've been able to build over the last few years.
Some other business news stories for you now. And the UK government said today that the stake taken by Emirates Telecommunications in Vodafone is a national security risk, and ordered the companies to take steps to mitigate it. The UAE-based company began buying shares in Vodafone in 2022 and raised its stake to 14% last year, making it Vodafone's biggest single shareholder. Well, under the order from Oliver Dowden, the Cabinet Secretary, the pair must establish a new National Security Committee to oversee sensitive work that Vodafone does, which could affect the UK's national security. Well, the order comes a day before the government is due to decide whether or not to refer Abu Dhabi's proposed takeover of the Telegraph Group to the Competition and Markets Authority. Lloyds Banking Group has announced it's cutting 1,600 jobs as part of its shift to online banking. The changes will also see 830 roles created as the bank expands its number of support staff. Well, the group, which owns Lloyds, Bank of Scotland and Halifax, said only 8% of its customers used high street banks as the sole way of managing their money. The consumer healthcare business Haleon has agreed to sell its chapstick brand to Suave Brands Company for $430 million. Brian McNamara, Haleon's chief executive, said that while chapstick is a great brand loved by many consumers around the world, it was not a core focus for Haleon. He went on, selling the brand allows us to simplify our business and pay down debt more quickly. We're confident the brand will continue to thrive under its new ownership. Well, Suave Brands Company, which is backed by the private equity firm Yellowwood Partners, was set up last year to buy the Suave beauty and personal care brand from Unilever. And just before Christmas, Yellowwood, its parent company, bought Elida Beauty from Unilever, buying it brands such as Q-Tips, Impulse, Timotei, Brute and Alberto Balsam. Shares of Dr. Martens rallied by more than 8% today after the footwear group reassured investors that sales and profits would be in line with expectations. That was despite news that sales during the final 3 months of last year came in at £267.1 million, which was down 21% on the same period in 2022. Kenny Wilson, the chief executive, said that trading in the quarter had been volatile, with December sales in particular proving soft, but they'd had a strong November. The UK car industry had a big revival in 2023, according to figures published today. The Society of Motor Manufacturers and Traders reported that more than 1 million vehicles were produced last year for the first time since 2019. The SMMT says that 1,025,474 cars and commercial vehicles were built, which was up 17% on 2022. Well, joining me now is Emma Butcher from the SMMT. Emma, good to see you. I mean, that looks an impressive recovery, but of course, the industry was coming for a low base in 2022 when there were a lot of part shortages.
Absolutely, yeah. It's been, as you say, it's been a real revival of fortunes this year, and it's amazing to see what can happen in 12 months. We weren't so optimistic 12 months ago, but over the last year, we've seen output perform ahead of expectations, and that's due to those supply chain challenges receding much quicker than expected. Still ongoing to some extent, but largely we've overcome those, which is great. Also, we've seen some new models come into production, and demand across the world has grown as well. So really good performance sets us on a really good stead for the coming 12 months and beyond. And on top of that, of course, we've seen billions and billions of pounds of investment ploughed into the sector this year, 24 billion almost, which is really much more than the last 7 years combined. So, yeah, a lot of optimism at the moment for the automotive industry in the UK.
Yeah, it was interesting to note that production growth accelerated during the year. I mean, it was up in 20% year on year in December. Has that momentum carried through into this year?
Yeah, we'll see what happens. Obviously, we're just looking at 2023 so far. We did see potentially a little bit of volatility towards the end of the year when we were waiting to see what would happen with the rules of origin governing the trade between us and the EU. That was all resolved very nicely, but came quite late in the day. So we will have to see what happens in terms of how strategies worked out. But certainly in the mid to long term, we see things continuing on an upward trajectory.
I mean, the export market remains absolutely critical. I mean, it looks as though 4 out of 5 cars produced went overseas.
Yeah, absolutely. It's the core part of what we do. Obviously, the domestic market is very important, but we are a global industry and trade with countries all over the world. The EU being our biggest market by far, and actually market share, export share there rose considerably last year. So about almost 2 in 3 of our exports went to the EU last year.
Car shipments to the US fell by 9.1%. That's the second largest export market. Why was that?
There are a number of reasons, and it really would depend on different manufacturers' export strategies. We did see the closure of one particular plant a year or so ago, which was heavily focused on the US. But you know, markets grow and shrink. But yeah, so strategies will change according to that.
I was quite struck to see that Turkey is now the UK car industry's 4th biggest export market. What's driving growth there and demand there?
Yeah, no, absolutely. Some good news there as well. And again, it's all about the product mix, what we're producing and what's happening in different markets around the world. So we're seeing emerging markets that we need to capitalise on, and also those really core key markets that exist and that we need to continue furthering our trade with as well.
One thing that struck me in the production figures, Emma, was that Nissan produced roughly 1 in 3 cars produced in the UK last year. Is the industry becoming overly reliant on just one manufacturer?
No, I don't think so. I mean, it's really important that we have these large and significant manufacturing plants, huge employer, and Nissan certainly up in the northeast, supporting jobs at that plant and right across the supply chain, and that's integral to the industry as a whole. However, it's a really broad and diverse industry. We've got those volume producers, but we've also got a really fantastic mix of specialist producers as well. You know, those kind of iconic brands producing out of Goodwood and Hethel and really making the UK quite a unique product offering.
OK, Emma, got to leave it there. Good to talk to you this afternoon. Thank you.
Bye-bye.
Still to come here on Business Live. Have a look at how the markets have finished this Thursday afternoon. Don't go away.
I'm Martin Brunt, and I'm Sky's crime correspondent. My most memorable story was, and still is, the disappearance of Madeleine McCann.
Please, please do not hurt her. Please give our little girl back.
We aim to be the best and most trusted place for news.
For detectives, the first 48 hours after a murder are crucial in the search for clues. The public expects them to find Jill Dando's killer soon. The British detectives are planning to meet forensic experts, academics, and even witch doctors.
I remember the grimmest case, the Soham murders of schoolgirls Holly and Jessica. I felt I can't undo what's happened, but I can help explain it.
Ian Huntley was arrested and charged within a fortnight of the murders.
I've never murdered anyone. I've never raped anyone. What am I in jail for?
The parole board has to decide if Bronson needs to be kept locked up for the safety of the public. My biggest challenge was to persuade a jailed diamond thief to answer my letters. Martin Brunt, Sky News, at the Old Bailey.
Fly Emirates, fly better. Fly Emirates, fly better. Thank you.
Well, the US dollar has risen on currency markets on the stronger than expected GDP data for the final 3 months of the year. As you can see, sterling off by nearly 0.25% against the greenback. The euro, meanwhile, off nearly 0.2% against the dollar. Sterling up against the euro by nearly 0.25%. That's on the comments from Christine Lagarde. The euro slightly depressed this afternoon. Over on the equity markets, well, European stocks have finished pretty mixed there, as you can see. Not a great deal in it. The MIB in Milan and the IBEX in Madrid both off by nearly 0.2%. There are some big gainers to mention today, though. And for the second day running, the Dutch chip-making equipment supplier, ASML, has hit a record high. It rose by some 6.5% yesterday on an upbeat trading statement, and it's risen another 4.5% today. And that means, for you statisticians, it is now Europe's third biggest company after Novo Nordisk of Denmark and LVMH of France. Well, here in London, the FTSE 100 has finished more or less unchanged right now in mixed trading. The leading blue chip gainer today was the asset manager Intermediate Capital, which has risen some 7% on a trading update. To the downside, a couple of other companies to have updated the market on trading today. The distributor RS Group, used to be called Electro Components, of course, that's off 3%, while the wealth manager St James's Place is off 4% again on a trading update. Outside the FTSE, the specialty chemicals group Elementis has risen by more than 12%. That is on a report on Reuters that it has rejected a private equity-backed takeover approach. Another mid-cap gainer to mention today is the tonic and mixers provider Fever Tree Drinks. That's up 6% on a trading update. Over on Wall Street, where the S&P 500 hit a fourth consecutive record on Wednesday, all of the main indices are currently trading to the upside, and that is despite Tesla, which is a real heavyweight in a lot of the indices, falling by 11%. That's after it warned sales growth last night would slow this year. To the upside, though, American Airlines is ahead by some 7% after its results beat expectations. The oil price, meanwhile, has continued to grind higher following yesterday's news of a bigger than expected drawdown in US crude inventories. A barrel of Brent crude will currently cost you $81.40 a barrel. That's up nearly 1.75% on the session. Joining me now is Joshua Mahoney, Chief Market Analyst at Scope Markets. Josh, good to see you this afternoon. Let's start with the ECB. I mean, no surprise about a lack of a policy change. It was Lagarde's comments that really moved the euro, wasn't it?
Yes, I mean, some would say it's probably a bit of a nothing burger when you look at what happened on the policy front, but certainly people looking towards those comments and want to really see that there's a sign that we're going to see a rate cut in the near future. Christine Lagarde and other ECB members have been trying to ward off expectations of a swift return to easing. But nonetheless, markets aren't having any of it. We saw pricing for that April meeting from 60% expectations of a rate cut, now at 80%. So markets really expecting the move that Lagarde is trying to hold off on in terms of expectations. And that, in my mind, is because of the fact that the trajectory of inflation for the Eurozone is really pointing towards a swift move back below that 2% target. If you tally up the past 8 months, we saw 0.7% of inflation. So plenty of room for maneuver for them to still be able to reach that 2% target by the time April comes around.
Yeah, it is amazing that they aren't making more noises about interest rate cuts, given some of the data coming out of the Eurozone right now is really quite disappointing.
Yes, and we've seen it once again today with the IFO Business Climate Survey. That is the leading indicator coming out of the German economy. We saw it fall to the lowest reading since summer 2020. It comes off the back of yesterday's manufacturing PMI reading, which improved, but it still remains well within contraction territory. So certainly we're looking ahead to the forthcoming GDP numbers next Tuesday from the Eurozone. And by and large, I think it looks likely we're going to see the Eurozone fall into recession with a second consecutive quarter of negative growth.
Well, that's a bad news story. On the plus side, I mean, the US GDP figures today really were quite a pleasant surprise.
Yes, but it depends who you're asking, right? Because markets at the moment would almost like to see a little bit of bad news on the US economic front because it really fires up those expectations around about a rate cut from the Federal Reserve. Nonetheless, we saw stronger than expected GDP, 3.3% for the fourth quarter. That is an annualized figure, so it's not necessarily just for the quarter alone, but well above that 2% expected by markets. We did see strength in terms of service growth. We saw a little bit of a dampening in terms of demand for goods, consumer goods for the period, strong exports, a little bit of a weakening in the imports picture. But taking that GDP number and a strong core durable goods number together, I think it points towards a picture where markets are trying to question why we're currently pricing for a potential coin flip, really, for that March meeting in terms of whether we're going to see that first rate cut or not.
Yeah, feels unlikely, doesn't it, Josh? What about Tesla? I mean, this was a really quite disappointing update last night on almost every measure.
Unfortunately, we saw underperformance on revenues, underperformance on earnings, and then to top it all off, we saw them really downplay expectations for demand in 2024. Look, ultimately, a lot of the time people are willing to really overlook the near-term weakness in favor of a strong outlook, or vice versa. A lot of the time, the outlook is really the most important part. And the fact that they're failing to give numbers on where they expect demand to be for the coming year and output, and we're seeing them really downplay those expectations from a sort of bigger picture, I don't think it's necessarily great for the stock, and we're seeing it really tumble today. But from a big picture, any time that you've seen in the past people really try to downplay and bet against Tesla, it has ultimately won out. So I wouldn't necessarily want to bet against Elon Musk myself.
Interesting point, that. What about, I know you're looking out for Visa after the bell. What's catching your eye there?
I think Visa is particularly interesting because of the fact that it's a company that has actually benefited from higher interest rates. It has benefited from higher inflation. Of course, one thing when we look down into retail sales that we find notable is we see lower volumes of sales, but higher value. And Visa really does benefit off the back of that. So it's had a particularly strong 2023. We're expecting more for 2024. But certainly this is a key bellwether for consumer spending anyway. So this should really glean some important information for us to be able to take forward when we're looking in terms of consumption in the fourth quarter for those key retailers.
OK, Josh, got to leave it there. Good to see you again this afternoon. Thank you.
Thank you.
That's it from me. I'm back again with Business Live tomorrow morning at 11:30. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Mark Austin with the News Hour. Before I go, a very happy Burns night to all our Scottish viewers. Hope you have a nice dram or two tonight. I might even join you. See you tomorrow. Cheerio.